Hey there, financial navigators. Ever wondered what makes a stock an absolute firecracker for potential short squeezes? It's not always about the biggest headlines. Sometimes the most interesting opportunities lurk in the less traveled corners of the market, driven by powerful, yet often misunderstood, forces like the cost to borrow. Today, we're shining our spotlight on a unique case that's popped up on our hard-to-borrow screener, VEEE. We'll break down exactly what makes VEEE stand out and what to watch for, even in its current peculiar state. But before we dive in, a critical note. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show VEEE stock ticker on screen. Alright, let's talk about VEEE. This is a microcap company, meaning it has a relatively small market capitalization. While its specific sector isn't readily defined, what immediately grabs our attention is its status as a hard-to-borrow stock with some truly eye-popping metrics. Now, let's look at the recent price action because it's a critical piece of the puzzle here. VEEE has shown a plus 0.0% change today. Looking at the broader picture, over the last 5 days, it's also registered a plus 0.0% change, and over the past 30 days, you guessed it, a plus 0.0% change. And here's where it gets even more interesting. Today's volume stands at 0 shares. The 30-day average volume? Also 0 shares. This gives us a relative volume of the ARC's average. These numbers tell us there has been virtually no trading activity in VEEE recently, which is an important context for its hard-to-borrow status. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why is it so important when we talk about short squeezes? Simply put, the cost to borrow is the annualized fee that short sellers have to pay to borrow shares of a stock before they sell them. Think of it like renting a car. You pay a daily fee for using it. For short sellers, this fee is paid to the broker who locates the shares for them. When a stock becomes hard to borrow, it means there are very few shares available to lend out, and often high demand from those who want to short it. This necessity drives the cost to borrow sky high, sometimes even exceeding 100% annualized, as we're seeing with VEEE. Why over 100%? Because these fees often compound daily, and the daily rate, when annualized, can reach astronomical figures, reflecting the extreme supply-demand imbalance in the borrow market. A high CTB indicates significant pressure on short sellers as their cost to maintain their position rapidly escalates. Why the stock is hard to borrow right now. Show VEEE CTB chart/data. Now let's zoom in on VEEE specifically. This microcap stock is currently sporting an annualized cost to borrow fee of an astonishing 950.7%. That's nearly 10 times the principal in a year just to hold a short position. And it's not just high, it's skyrocketing. The CTB momentum for VEEE shows an increase of plus 880 percentage points over just the last 5 trading days. That's an explosive rise. Adding to the scarcity, there are mere 100 shares currently available to borrow, against an estimated float of just 0.4 million shares. Our internal composite squeeze score for VEEE, which combines all these factors along with volume and technicals, stands at a notable 70.9 out of 100. However, it's crucial to address the elephant in the room, the extremely low, in fact, 0 reported volume for VEEE recently. While the CTB metrics are screaming for attention, 0 volume means virtually no trading activity. This makes any immediate short squeeze scenario highly improbable without a significant catalyst to reignite interest and liquidity. It's a fascinating dichotomy. Squeeze mechanics explained. So, how does a short squeeze actually work? Especially in a situation like VEEE's, assuming liquidity returns. When a stock is hard to borrow and the cost to borrow is extremely high, short sellers are under immense pressure. If the stock price starts to rise, short sellers face increasing losses and potential margin calls, forcing them to buy back shares to close their positions. This buying pressure, in turn, pushes the price even higher, creating a feedback loop where more shorts are forced to cover it, amplifying the upward momentum. This is the squeeze. A shrinking supply of borrowable shares, as we see with VEEE's 100 available shares, means that even a small amount of buying can have a disproportionate impact. But here's a crucial caveat, especially pertinent to VEEE's current state: the high cost to borrow does not guarantee a squeeze. It can also mean that short sellers have very strong conviction in their bearish thesis and are willing to pay exorbitant fees to stay short. And without any volume, a squeeze simply can't ignite. Dilution risk check. One of the biggest silent killers of a short squeeze thesis is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. While this can raise capital for the company, it dilutes the value of existing shares and, critically for our discussion, it provides new supply that short sellers can potentially borrow, thereby alleviating the hard-to-borrow pressure and reducing the likelihood of a squeeze. For VEEE, a check found no recent diluted SEC filings such as -1, -3, or 424B in the last 90 days. We also found no recent reverse split for VEEE in our look-back window. This is generally a positive sign, as it removes one significant headwind that could otherwise negate the high cost to borrow and squeeze potential. Again, a quick reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given VEEE's unique profile, astronomical CTB but zero trading activity, what should you be watching for? The absolute first thing to observe is the return of volume. Without liquidity, even with an annualized CTB of 950.7%, the mechanics of a squeeze cannot properly initiate. Look for any sustained increase in daily trading volume from its currency or shares. Next, continue to monitor the cost to borrow and shares available to borrow. Will the CTB continue to climb, or will it begin to drop if shorts cover in anticipation of future volume? Any news or fundamental catalysts for VEEE could also reignite interest and bring back liquidity, which would then make the high CTB numbers truly relevant for a squeeze scenario. Keep an eye on any price movement, even small ones, as they could signal renewed interest. VEEE presents a truly fascinating, albeit highly liquid, case study in the world of hard-to-borrow stocks. With an astounding 950.7% annualized cost to borrow and only 100 shares available to short, the metric suggests extreme pressure on short sellers. However, the critical absence of any trading volume means that, for now, VEEE remains a potential powder keg without a fuse. The lack of recent dilution is a positive, but the market needs to wake up to VEEE for its squeeze potential to become actionable. Always remember, the market is complex, and high CTB is just one piece of a much larger puzzle. Do your homework, understand the risks, and stay informed. If you found this deep dive into VEEE insightful, hit that like button, subscribe for more unique stock analysis, and tell us in the comments, what hard-to-borrow stock are you watching? We love hearing your thoughts.